Hey, good morning. This is Mayor Valensky with Driving Markets. Driving while talking about markets. Okay, quick caveat, anything said in this piece is an opinion only. It's only for media, and obviously any trading you do on your account, whether it is makes a profit or a loss, that is yours. So off we go. So the markets last week, especially on Friday, jumped up significantly. Wow, there was a lot of underlying pressure there, and what happened was the corporate earnings came out positive or better than expected, and that just shot up, and that just pushed all the markets up dramatically. The Dow closed up like 748 points, and what's probably likely to happen is that momentum is likely to continue for the next day or two as the markets look to push up. So the bulls want to take control of the market. Now the question is, why did the market go up? Not just on the back of corporate earnings, there's also another factor you need to take into account. We spoke last week about inflation being a lagging indicator, not a lead indicator. In other words, it's an historical number, what's happened in the past. So there is a view or feeling on Wall Street and in global markets that maybe inflation has peaked. And if inflation is peaked, then interest rates essentially has peaked. Now, even if inflation hasn't peaked and it goes up by another 0.1, 0.2, again, this is not my view. This is a view of what the analysts and the bankers are saying as regards inflation and interest rates. They believe interest rates have definitely peaked. They don't believe that the central banks, especially the Fed, is going to continue to raise interest rates beyond December, beyond January next year. I take the view that they're all completely and utterly wrong. I remember I've been the contradictory view since January this year, when the analysts and all the experts were talking about a maximum by year end 2022 of interest rates at 1%. And I said already back in January, February, March, interest rates are going to be, back then, I said straight away they're going to be 3.5%. Then I adjusted that through the year to 4.5%. We're going to finish on 4.5%. We're talking about the US, yeah? We're talking about the Federal Reserve, what level of interest rates they're going to be increasing by. And it's going to be around about the 4.5% by year end. Now, I'm taking the view also that I don't believe interest rate cycle has come to an end, because I do believe there is a very strong undercurrent of inflation running globally, not just in the US, not just in the UK, not just in Europe, but across the world. And we're living now in a new era of inflation, and it's going to continue all the way through to 2023. So I'm going to stick to my guns, and I can see interest rates in the States running at 6.5% to 7% in 2023, and even into 2024. Only the end of 2024 you may see a significant drop in inflation. Now, the view opposing me is that the cost of housing or the cost of rentals will come down, which is a big part of the inflation calculation, and therefore if that comes down, effectively the cost of living comes down. That is true, but I'm weighing into the cost of actual daily living, which is the cost of foods and groceries, electricity, energy bills. I think they are just going to continue rising. The other factor impacting on inflation is full employment. As long as you've got full employment, then you're going to have that demand, that consumer demand, which is going to drive and push prices higher because of full employment, and everyone has that regular income coming in. And I can't see employment falling, maybe in the high-tech sector, which I've been saying that they're going to start laying off people. Remember, it was the high-tech sector that's been pulling up the markets for the last 6, 7, 8 years, and it's the high-tech sector that is going to drive the markets down. Talking about high-tech, I've got to mention last week's Snap results that came out, which were absolutely terrible, and as a result of that they dropped more than 25%, and that impacted on other media companies like Meta Facebook, whichever it's called, Twitter, and other media social platforms. Now, what happens is that all those companies are well overrated. So I've been calling Meta Facebook to drop below the $100 level by the end of the year, followed on by Amazon and Apple. Another comment passed to me was, well, if you've got it all right, why are the markets bouncing? Remember, what I'm talking about is macro fundamentals. I'm not talking about a minute by minute, day by day. I'm not sending charts out and saying, look, the pound's going to fall in the next 5 minutes and you've got to trade it. That is a day trading. I'm not talking about day trading here. I'm talking about an overall macro picture, a swing trade on markets. And the market's trend is going to be down, even though within that there's going to be days when the market is going to bounce. I've got to return back to the UK and focus on what's happening in the UK. There's a movement to bring Boris back. I actually am a big fan of Boris and I forgive him, so if he comes back it'd be absolutely great. Whether he had a party at Corona, didn't have a party at Corona, who cares? Doesn't really matter. It's no big deal, honestly. Anyhow, so Rishi Sunak looks like the favourite to become Prime Minister. Now, he's an ex-Goldman Sachs analyst and he was Chancellor of the Exchequer, or in simple words, he was finance minister in global terms, so or global expression of finance minister, and he will do a pretty good job as regards running the UK. And what the UK needs to do, and I want to emphasize and stress this, is quite simple. They need immediately to cut public spending, and on top of that to raise interest rates. Now, both of those actions will put confidence back into the UK economy as a global financial leader, because what Liz Truss did in Kwasi Kwarteng was quite simply knock all that global confidence and make UK a junk status. So Rishi will put the confidence back in. He's a good leader, was a good finance minister, and I think if Boris comes back, which is a really outside chance, but it would be great if he comes back because he's got flair and he's dynamic, charismatic, then that also would add confidence as far as the UK is concerned. The UK pound needs to be back up there against the dollar at 135, 140. It's far too low. And if it manages to hold on to these levels, then it looks like a buy. And the other area I want to just mention is Bitcoin, which is also a big popular favorite. That's floating at 19,300, but can't seem to break out of this restrictive top out 20,000 level. And it looks like, and I feel as though it's going to go down more likely to 15,000 than to 25,000, put it that way. As regards other assets that people trade, gold jumped up from 1623 to 1657 last week. It's trading around about the 1660 level. Again, looks like at the 1620 it's got massive support, so it could be a buy at those levels. As regards oil, I state over and over again, OPEC will not allow oil to fall below the $85-80 barrel level. They'll just keep on cutting production to make sure that's more towards the $100 than it is towards the $80. Overall, and then you've got on Thursday you've got ECB, massive interest rate decision in Europe, probably going to raise interest rates by 75 basis points, already priced in. But the euro is very, very weak and Europe is well behind the curve. You've got German and French inflation on Thursday and Friday. That'll be very interesting. UK inflation last week came in at 10.1%, likely to go higher, especially if they ban the subsidy on energy bills. You can expect inflation to go much higher. This is it. This is all for now. This is Mayor Walensky with Driving Markets, talking about markets while driving. Subscribe, comment, pass it on. Have a good day.